Joining us now in an exclusive interview is Curaleaf Chairman and CEO Boris Jordan. Boris, great to see you again.
Great to see you. Good to be here.
So Aurora has since formed a special committee. Have you engaged with the special committee at all?
I've had one, not with the special committee. I did have a conversation with their CEO after the launch of the bid. It was a very brief conversation. He said to me that he was waiting for the official launch of the bid, which took place this morning. And so now we're going to be reaching out over the next 24 hours to see if they'll engage with us to have a conversation.
Part of your case for the merger is basically that the company Aurora faces headwinds in the Canadian market in medical cannabis as well as consumer cannabis. How does putting the two companies together resolve those issues?
Well, Curaleaf's main business outside of the United States is in Europe and Asia. We're the largest distributor of cannabis in those markets. And so Aurora fits very well from our perspective because our supply chain has been constrained with a lack of quality product. Aurora has very good facilities in Canada, facilities that we think we can increase the productivity of by almost double and supply our distribution both in Europe and in Asia to distribute those products. And so it's a very, very good fit strategically for both companies.
Hey, Boris, it's Tim. I think it's a great strategic fit as well. I guess there's so many subplots for investors that I think are bullish here. I run a cannabis ETF. Curaleaf is a core position in my fund. But it's Canadian companies that have actually, first of all, Canada's consolidated. A lot of companies like Aurora have cleaned up their balance sheet at the expense of equity shareholders, but not at your expense if this deal goes through. So Canadian companies look better. There's excess capacity that at one point was never going anywhere. Now there's a lot of places it could go. There's an argument that the international markets are incredibly attractive and that Europe is, 27% growth for you year over year. The fact that you have the free cash flow to make a purchase that's both cash and shares is also bullish. And there's a NASDAQ listing at stake here, too, if ultimately there was some consolidation. Which of these, and this isn't, if you're an investor out there looking at the cannabis industry, there's so many elements about what you're doing here that to me are bullish for the industry. And this may sound like a homer, but I guess, I'm curious what you think is the greatest takeaway of what you're up to right here.
Listen, this is just a massive strategic fit. I look at this from an operational perspective first. It has to make sense for the company, for us. It obviously has to make sense for Aurora. And then it's got to be a good deal for all shareholders. So strategically, it fits like a glove. You have the largest operator globally in the form of Curaleaf taking on a very high quality but very small operator in Canada that can supply our distribution networks nationally. Aurora in and of itself is not doing well, right? Their Canadian business is shrinking. Their Australian business is shrinking. Their quarter after quarter, they've disappointed earnings. They've written off $6 billion of value to their shareholders. It's time to transfer this asset into a company like Curaleaf that has massive tailwinds, not only in the form of our very double-digit growth in Europe and internationally, but more importantly also that Curaleaf is about to, hopefully, with the changes taking place in Europe, have a significant reevaluation. So that's why we structured the deal with 80% in stock and 20% in cash. So the Aurora shareholders that have no access to the U.S. market today can get access into the largest player, both in the U.S. and internationally, and it makes very good sense from a strategic perspective for Curaleaf.